Hey everyone and welcome. Today we're breaking down the anatomy of a potential market rally. We're going to decode all the technical signals that suggest a major AI stock, after a pretty steep fall, might be coiling up for its next big move. So let's dive right in. So picture this. You've got a stock that's been flying high, and then bam, it takes a serious hit. It corrects sharply, and now everyone's asking the same thing. Is the party over, or is this the exact buying opportunity I've been waiting for? Well, that's the big question we're tackling today.
And look, we're not going to beat around the bush. The verdict from all the source analysis is pretty clear-cut. A confirmed buy setup is officially active. But the real question is, how did we get to this conclusion? Let's unpack all the evidence, piece by piece.
Here's our roadmap for this breakdown. We'll start with the final conclusion, the answer first. Then we'll zoom out to the big picture. After that, we'll get into the nitty-gritty evidence on the charts, map out the key price levels, lay out a real, actionable game plan, and finally, see how this all fits into what the rest of the sector is doing.
All right, first up, a setup confirmed. Like I said, we're giving you the bottom line right at the top before we show you all the work.
So here it is. This is the definitive statement from the analysis. What it's basically saying is that the painful drop we just saw, that was a predictable corrective phase, a wave 4, and that phase is now over. The next major move up, what's called a wave 5, is believed to be starting right now with some pretty significant upside from here.
Okay, so that's a pretty bold call, right? Where does it even come from? Well, to understand the why behind it, we need to look at the big picture story being told here. And that story is framed by something called Elliott wave theory.
Now don't let the name scare you off. At its heart, Elliott wave theory is actually pretty simple. It just suggests that markets move in predictable, repeating patterns because they're driven by human psychology. The crowd swings between optimism and pessimism. It's like a natural rhythm.
So the really crucial point is this. According to the analysis we have just finished, step 4, that corrective wave, which seems to have found a bottom right in that 172 to 175 zone. And if that's true, it means we are right at the very beginning of step 5, the next big rally. This is the entire foundation for the buy idea.
Okay, so that's the theory, that's the big story, but talk is cheap, right? We need to see some actual proof. So in this section, we're going to go from that big story down to the fine print, looking at the technical evidence across different time frames to see if the charts actually back this all up.
Let's zoom way in to the 30-minute chart. We're seeing immediate signs of life here. Key momentum indicators like the RSI are bouncing back from oversold territory, and the MACD, which tracks trend, has just flashed a positive signal. Plus, the price is clawing its way back above key short-term averages. All of this tells us the sellers are getting exhausted and buyers are finally starting to step in and take control.
Now, zooming out a little to the 4-hour view, things get really interesting. We see this powerful bullish engulfing candle. All that means is you have one period where the buyers just completely overwhelm the sellers, a huge reversal of power. And crucially, this happened on a big spike in volume. That's the confirmation. It tells us real money and strong demand are behind this move.
And if we zoom all the way out to the daily chart, we get some real reassurance. Look, despite that recent nasty drop, the price is still way above its long-term 200-day moving average, which is a key sign of a healthy uptrend. The big picture? It's still bullish. This correction looks like it was just a pause, not a total breakdown of the trend.
All right, so we've got the theory and we've got the evidence. Now let's get practical. Let's map out the specific price levels that really matter, the battlegrounds where the buyers and sellers are about to fight for control.
So think of support levels as a floor under the price and resistance levels as a ceiling. That key floor was right down there in the 172 to 175 zone, and the stock bounced perfectly off of it. Now, the next major ceiling it needs to break through is around that 189 to 190 area. If it can clear that, it really opens the door for a much bigger move higher.
And this brings up another really cool concept. This sideways price action after a drop, it's often called a reaccumulation phase. And honestly, the best way to picture it is like a powerful spring being compressed and coiled tighter and tighter. The more coils, the more explosive the potential release to the upside can be.
Okay, so this is the part you've probably been waiting for. How do we turn all of this analysis into an actual concrete plan? This next section lays out the specific, actionable game plan that comes from all this research.
Here it is, laid out plain and simple. an ideal entry zone between $179 and $182, a very clear stop loss just below that recent low, down at $171, so you know exactly what your risk is. And then 2 potential targets, with the main one aiming for that $205 to $211 zone. Now this number right here, this is arguably the most important piece of the entire puzzle. It's the risk-to-reward ratio. For this specific setup, the potential profit is more than 3 times the amount you're risking. That is a highly favorable setup, and it's exactly the kind of thing professional traders are always looking for.
But of course, a plan is useless without rules for how to actually execute it. This isn't about just jumping in blindly. The logic here calls for patience, waiting for specific confirmations, like a strong close above a key price level. It also includes smart trade management, like taking a little bit of profit at the first target and moving your stop loss up to protect your original capital. It's about being strategic.
All right, so far, we've gone really deep on this one single stock. But here's a critical question. Is this just a one-off thing happening in a vacuum, or is there something bigger going on here? Let's zoom out one last time and check the health of the entire sector.
And what we find is pretty fascinating. Other major players in the same industry, stocks like AMD and TSM, are showing very similar patterns of strength. Even the main ETF for this sector, SMH, is bouncing hard off a critical support level. You know the saying, a rising tide lifts all boats? And it really looks like the tide might be coming in for the whole sector.
So the huge takeaway here is that this isn't just one company's story. It points to a much bigger theme. It looks like money might be flowing back into the entire AI and semiconductor space after a much-needed cooldown. And that adds a really powerful tailwind to our original idea.
And all of this leaves us with one final provocative thought. If this analysis holds up, and an entire leading sector of the market is just beginning its next major advance, what might that signal for the health and direction of the broader market as a whole? Definitely something to think about.
You know, whenever NVIDIA is about to drop its quarterly earnings, it feels like the entire market just stops and holds its breath. This isn't just about one company's numbers. It's become a huge moment, really a referendum on the entire AI revolution that has completely reshaped Wall Street.
And the stakes? They couldn't be higher. I mean, think about it. Since this whole AI boom really kicked off back in late 2022, NVIDIA's stock has just gone vertical. We're talking up around 1,000%. It even briefly became the most valuable company in the world. It has been an absolutely wild ride.
So that really brings us to the big question, right? Is this incredible growth actually sustainable, or has the hype gotten way ahead of the reality? This one earnings report could give us a major clue.
All right, so here's how we're going to break this down. First, we'll get into why NVIDIA is seen as the ultimate litmus test for the AI market. Then, we'll walk through 3 possible scenarios for their report and the ripple effects of each. And finally, we'll wrap up with what it all means for you.
So let's dive right in. This report, it's not just another earnings call. Think of it more like a barometer for the health of the entire AI investment narrative. The results are going to send a huge signal about whether this frenzy is justified or if, maybe, things have gotten a little too hot.
You have to understand, NVIDIA is operating in this massive tug-of-war right now. On one side, you have these incredible tailwinds, just unheard of amounts of money pouring into AI, inflation cooling off. But on the other side, there's some serious headwinds. Interest rates are still high, there are US export restrictions, and people are constantly worried that valuations have just gotten too crazy. This quote just says it all, doesn't it? So goes NVIDIA, so goes the market. And it's not an exaggeration. When a single company makes up something like 8% of the S&P 500 and a whopping 10% of the NASDAQ 100, its every move can literally pull the entire market up or down with it. The rally we've seen has been riding on its coattails.
And if you really want to get what makes NVIDIA tick, you've got to follow the money. Look at this, a huge slice of their revenue, we're talking over 40%, comes from just 4 giant customers. So NVIDIA's future is directly linked to the spending plans of Microsoft, Amazon, Google, and Meta.
All right, let's play this out. Scenario number 1, the absolute best case. This is what happens if NVIDIA doesn't just beat expectations, they completely blow them out of the water. A report like this would tell us that the AI spending boom isn't slowing down, it's actually speeding up.
If this happens, the ripple effect is going to be instant and massive. NVIDIA stock, it would just surge, probably locking in a market cap north of $5 trillion. Its competitors, like AMD, would rally right along with it. You know, a rising tide lifts all boats. And that good feeling would spread everywhere, firing up the AI rally all over again and pushing the whole market to new highs.
And this is exactly the kind of language you'd hear from management, right? Demand is still extraordinary and growing. It's their way of telling the world, hey, this party is just getting started. There's plenty more to come.
Okay, so that's the dream scenario. But what about scenario number 2? What happens if NVIDIA's results are just fine? You know, they hit their numbers, they meet the incredibly high bar Wall Street has set, but they don't deliver that huge upside surprise. This is where things get a little weird with market psychology. We could actually see what's called a sell the news reaction. And you might be asking, why would the stock go down on good news? Well, it's because those super high expectations are already baked into the price. Anything short of perfection can feel like a letdown. So the fallout here is way more muted. NVIDIA's stock might just trade sideways, maybe even dip a little. Other AI stocks get some reassurance that the trend is real, but there's no new excitement to push them higher, and the overall market would probably just kind of drift.
And this quote really hits the nail on the head. The expectations are just so incredibly high that simply meeting them, well, that might not be enough to get investors excited for more. The bar is just that high.
And that brings us to our final scenario. The one that, let's be honest, probably keeps some investors up at night. What if the golden child of AI finally stumbles? This is what could happen if NVIDIA actually misses its numbers. Or, and this is just as bad, gives weak guidance for the future.
The outcome here? It would likely be fast and, frankly, pretty brutal. A miss would almost certainly kick off a massive sell-off, and not just for NVIDIA, but for the entire tech sector.
Just look at the potential chain reaction here. NVIDIA itself could plummet, maybe 15–20%. Its competitors would get dragged down with it as investors start to question the whole AI chip story. Other popular AI stocks would get hit hard as the air comes out of the AI bubble, and the whole market could get pulled into a correction.
Yeah, a miss wouldn't just be a bad day for the stock. As this quote says, it would seriously challenge the whole narrative that's been propping up this market for the last couple of years. It would be a fundamental test of the AI rally.
Okay, so we've looked at 3 totally different outcomes. Let's step back for a second and talk about what this all means for you, no matter what happens.
First, you really need to get this term, bellwether. It's the perfect word for what NVIDIA has become. It's like the lead sheep with a bell around its neck. Wherever it goes, the rest of the flock. In this case, the entire AI market is probably going to follow. Its results are the signal everyone is watching.
In this slide breaks down the key lessons really nicely. If it's a blowout, great! The AI train is still chugging along. But just be careful about those sky-high prices. If it's just in line, that tells you the trend is solid, but you gotta be smarter about which stocks you pick. And if they miss, well, remember that market corrections can be healthy, and they often create great buying opportunities if you believe in the long-term story. It's also a great reminder of why diversification is so important.
Which brings us right back to the big question hanging over everything. Is this report going to kick off the next great chapter of the AI revolution, or is it going to be the cold splash of water, the reality check that a market this hot might actually need? We are all about to find out.